All right, let's jump right in. Today, we're going to explore a really different way of looking at financial markets, and more importantly, how to manage risk. It's a framework called market DNA, and it's all about the idea that you can trade not with indicators and gut feelings, but with a fixed geometric blueprint.
Just think about that for a second. What's the single biggest source of stress for any trader? It's the unknown, right? It's that fear that a trade could just go completely sideways on you. This whole model starts by tackling that question head on, trying to turn that unpredictable fear into a predefined certainty.
So on the left, you've got what trading feels like for so many people. It's a mess, right? A chaotic blend of emotions, a dozen different indicators, just a ton of noise. But on the right, you see the market DNA approach. It's clean, it's precise. It's all based on the idea of an underlying geometric structure. It's a massive shift from chaos to control.
And this really gets to the heart of the problem, that constant stress and second guessing. You know the feeling, right? Is my stop loss in the right place? Did I risk too much on this? That unpredictability is the core issue that this entire geometric framework was built to solve.
Okay, so let's get into the solution. The core idea here is to just stop reacting to all the market noise. Instead, you start with a map, a geometric structure that actually predefines the rules of the game before you even start playing. And this image, well, it really gets to the heart of the whole metaphor. Instead of seeing a random, chaotic series of candlesticks, this model says the market has a pre-encoded, decodable structure, kind of like a strand of DNA. And the whole goal is to learn how to read that code so you can define your risk way ahead of time. This right here is the foundational principle. It's the bedrock of the whole system. Before you can even dream about profits, you have to guarantee you can stay in the game. And that means capital preservation isn't just a nice idea, it's the absolute #1 priority that guides every single decision. So to build this kind of geometric system, you first have to clear out all the clutter. This model completely rejects all of these common tools. But why? Well, because every single one of them introduces subjectivity and noise. They're all reactive. They tell you what's already happened. This framework is designed to be predictive, based entirely on a predefined mathematical structure. So you might be wondering, okay, if I'm not using any of my usual indicators, how in the world do I even build a trade? Well, it becomes a purely mechanical process. You start with a set of fixed parameters, and those act as the inputs for a formula. There's no guesswork, and there's no emotion involved. And here are those building blocks. Before a trade is ever even on the table, you have to define these 5 things. You've got your capital and your absolute pain tolerance, then the structural entry points, which are just key price levels that the model's geometry points out, and then a couple of risk coefficients that are also derived from that same structure. Once you have all those fixed inputs, then and only then can you calculate the one thing that's left, your position size. Now, this is probably the biggest mindset shift of the whole system, how it treats maximum drawdown. In most trading, drawdown is this terrifying outcome you're desperately trying to avoid. But here, it's a controlled variable. It's a tool. It's your non-negotiable budget for a worst-case scenario, which completely transforms it from a fear into a plan.
And all those inputs we just talked about, they all get plugged into one single, stable formula. This is really the engine of the system. It takes all of your risk parameters and it spits out the only thing left to decide, exactly how much to trade. And this removes the single biggest reason most traders fail, letting their emotions decide their position size.
Okay, that's enough theory. Let's make this real. We're going to walk through a case study using Bitcoin to see exactly how all these pieces fit together in the real world. All right, let's build a trade from the ground up. The first input couldn't be simpler. Our capital. Let's say our trader is allocating $100,000 to this strategy. Next up, and this is so important, we define our pain tolerance. The trader decides their maximum drawdown is 15%. This is a critical decision made before any trade happens. It means the absolute most they are willing to lose is $15,000, period. That number is now set in stone. Okay, now we consult the geometric map. For this particular Bitcoin structure, the model identifies 2 key price levels, a primary entry, M, and a corrective entry, PC. The strategy is to build the position across these 2 mathematically important points. And what's crucial here is that these aren't just subjective lines someone drew on a chart. They are fixed points dictated by the underlying geometry. So with our capital, our max loss, and our geometric entry points all locked in, the formula just does the work, and it spits out the answer, a total position size of precisely 0.31026 Bitcoin. Not more, not less. It's the only mathematically correct size that honors our risk limit. And here it is. This is the magic number, the most important output of the whole process. The model calculates a structural stop loss at $38,921. Now, this isn't a guess. It's not a suggestion. It's a guarantee that if the price hits this level, our loss will be exactly $15,000, our 15% max drawdown. The worst-case scenario is no longer a fear. It's a known number. So let's zoom out for a second and look at the payoff for all of this structure. Why is a deterministic model like this so powerful? Well, it's because it shifts the entire game from one of guessing to one of statistics.
And this table shows you exactly where that statistical edge comes from. By capping every single loss at a fixed amount, that 15 grand in our example, the model can actually maintain a positive expected value over time, even if you're not winning every single trade. I mean, look here. Even with 2 losses out of 10 trades, the system still generates a net positive return of over 19%. That limited downside is what creates the long-term statistical advantage.
So, to wrap it all up, the advantage is pretty clear. You get a predictable, known maximum loss on every trade. The entire process is rule-based, which pulls your emotions out of the driver's seat. Your risk is defined by stable geometry, not lagging indicators. And all of that creates a positive mathematical expectancies that can be scaled across pretty much any market. FX, crypto, indices, you name it. If you only take one single thing away from this whole explainer, let it be this. This approach fundamentally changes what risk even means. It stops being a random, scary outcome of a trade, and it becomes a predefined structural constant that you actually control before you ever click buy or sell.
It's a really radical departure from how most people think about the markets, for sure. And it leaves us with one final big question to think about. If risk really can be engineered and defined with this kind of mathematical precision, could a geometric blueprint like this one change how we all see financial risk? Forever?